You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome again to OIC's Wide World of Options. My name is Mark Benzaquen, and joining me today is 20-year options veteran, former floor trader, and one of my colleagues here at OIC, Matt Cashman. Matt, thanks so much for stopping by and joining us today.
Absolutely. Thank you for having me. I'm really happy to be here and happy to spend the morning talking about options.
Excellent, Matt. Thanks. So speaking of options, one of my favorite things about them is their versatility as an investment vehicle. If you remember when smartphones first came on the scene, there was a popular saying, there's an app for that. And that kind of spills over to the options world in that no matter the investment objective, there's a strategy that can help meet that objective. So would you mind, Matt, taking a few minutes to start us off and talking about the versatility of options?
Yeah, absolutely, Mark. Thanks a lot for that lead. And I think that's really one of the overarching kind of facets of the option world that is most interesting because it provides a real, a very broad-based way for people to use options. They're so flexible and they're really, you can customize them in so many different ways. But let's talk a little bit about why people use options in that case, and that'll kind of lead us into some of the ideas of, and we'll be able to dig deeper into how those concepts work. But really, when I first started learning options, they were taught as very specific kind of investment goal oriented strategies. And so those things still are, very viable as far as investment goals are concerned. But as your knowledge base starts to grow around options, you start to really understand that those individual investment goals and strategies can be combined into much larger and more sophisticated and more leverage intensive positions that can yield lots of different things. And so let's talk about the building blocks a little bit of why people use options, and that might lead us into some other more interesting things. But one of the first things that people use them for is simply to mitigate risk. They're a way for people to be able to, control how much risk they have in their underlying stock positions or their underlying index positions or even commodity positions. It's a way, and one of the really kind of simple ways that people use that in those terms to mitigate risk is you can do things like buy puts against an already existing or an underlying position that you're starting to enter into. And so puts, for those who are kind of uninitiated into the options world, are the right to sell the underlying at the strike price on or before the day of expiration. And so if you're long an underlying stock, a put and buying a put is a way to be able to give yourself an exit point price-wise that you would be able to exercise that put and actually exit your long stock position. You'd be able to actually sell that stock position to someone else on the strike price that you had agreed upon. And so that's a way that people use options. It's a very flexible way. You can, choose lots of different strike prices, lots of different durations as far as the option is concerned. And that's a really flexible way that you can use it to mitigate risk. The second way people use options in general is, and one of the things that options have inherently within them, is that they provide leverage. And so options in the United States equity market, generally, if you're trading equity options in the US equity market, options control, for every one lot of options that you trade, you actually control the right to buy or sell the stock, depending on what option you're trading, for 100 shares of the underlying. And so what that allows you to do is it allows you to take a much smaller footprint as far as notional value in your account, and you're tying up much less of a notional trade in order to control a much larger notional trade on the back end if you were to exercise that option, for instance. And so now, leverage is another reason. Yeah,
Matt, when you're talking about notional, you're talking about the capital required for the transaction. Is that right?
Yeah, I'm just talking about the premium that you're paying for an option versus the premium that you would have to actually tie up to be long the stock.
Got it. Thank you.
And so the actual notional value, in those terms, is much less relative to how much you would, end up using to buy or sell the stock. And so leverage is one of those things that's inherent within the options. Now, another way that people use options is they use them for speculation purposes. And so generally speaking, when I talk about options in terms of speculation, I think about speculation not in a, it's not a dirty word to me. A lot of times that word gets kind of a bad rap in, the investment world. But speculation to me just means that you're, maybe trading the option without having an underlying position in the stock or the index underneath it. And you're actually using the options to speculate on that very option being worth more or less later on than what it is now. And so that to me is really the speculative aspect of options. And we can get into later on how that, what kind of factors make those things move up and down from a speculative perspective. But, the last real way that people use them is they use them for income generation. And income generation to me is one of those things where it's been really important over the last 10 years because people generally, when they're looking for yield, right, they're looking in a general marketplace right now that doesn't provide a whole lot of yield. There's not, the risk-free rate is pretty low, relatively speaking, on a timeline. And so options, when you're selling options and you're selling premium, you are actually getting that premium in your account. And if it's against an already underlying stock position, you're really just using those options to trade against your underlying position. And so that premium that you're actually selling and you get to keep in your account is something that people look at, generally speaking, as a kind of yield against what they're actually holding in their underlying position. And so those are really kind of some of the building blocks that go into options as far as why people use them. But the overarching idea is that they're really customizable. They provide so many different ways for you to actually use them.
Absolutely, Matt. And that speaks to the versatility of options and what a unique investment vehicle it is. You had mentioned income generation, and that's something that I want to zero in on for today's podcast. So it seems that many investors, they are of the same mind that options might offer a path to additional income simply by selling calls and puts, or a combination of them. And especially with that misconception out there that 80% of options expire worthless. So let's go ahead and begin this discussion of income generation by dispelling that misconception and talk about what the real numbers are in terms of exercise and assignment, contracts expiring worthless, and contracts that are closed out ahead of time in the marketplace. So let's start with that misconception that 80% of options expire worthless. Matt, do me a favor, take us through what the real numbers are, if you would, please.
Yeah, absolutely. That's a really good point. So the real numbers are this, and we know this because OCC keeps track of these numbers. 72% of all contracts are closed out ahead of time, meaning if you are short calls against an underlying stock position, or if you're just short calls or whatever, let's say that's your position, that you are actually buying those same calls back before they expire and closing your position. So 72% of all contracts are closed out ahead of time. 8% of contracts on the whole are exercised. For instance, like that example I gave you earlier, where you're long stock and you're long puts, and let's say the stock drops below a certain point, you want to exercise your put, you would exercise your put. You would be part of the 8% of the options that are actually exercised before they expire. The rest of them, so 72 and 8, that gets us to 80, which gives us 20% of these options expire worthless. And so what you're really looking at here, that 80% number that expire worthless, that is kind of like people kind of bat that number around back and forth in the, in when people are kind of talking about options in a general way. It's important to understand that, that's not really an accurate description of how options work in the real world. It's not, 80% of them don't actually expire worthless. It's more like a 20% number. And so those are the real numbers as far as how they actually work. It speaks to a little bit of a different kind of mindset as far as if you think about it in those terms. Those two numbers provide a pretty different picture of how options work in the real world, right? It's a totally different idea about how that actually plays out.
Absolutely, and the numbers show that, as you had mentioned, that 20% of options expire worthless, and as you know, with the mindset of an option seller, a lot of them, their ideal outcome is that the contract expires worthless and the premium that they collect when they first implement the trade is theirs to keep as profit. So with that 80% misconception, sellers are thinking, well, why don't I just sell options? I'm going to be right 80% of the time. And actually, as you had, so eloquently and accurately portrayed, that actually isn't the case. So what it shows us is that selling options may not be as risk-free as the majority of the investing public, or at least the majority of the beginner options public, if that's a thing, that they may not be as risk-free as people believe. So one of the things that we are so determined here at OIC is to educate investors as to not only the potential rewards of investing with options, but the risks that go along with them well. So let's go ahead and stay on that track of options risks when it comes to selling. And let's start with calls. Matt, do me a favor, take us through the risks of selling naked calls and how that risk can possibly be mitigated with a covered call strategy, for example.
Yeah, absolutely. I think it's a really good way to kind of segue into some of where the proverbial rubber meets the road as far as the actual risks of what some of these contracts really involve. And there's really two ways. Well, there's a lot of different ways that you can be short calls, but let's talk about two of them first and foremost. The first way would be kind of what I would term as speculative, using our definition from before, where if you're selling calls without an underlying position, we would kind of generally term that as a speculative call trade. Now, let's talk first and foremost about what calls are. I talked about puts earlier, and puts are the right to sell the underlying on or before the date of expiration at the strike price. Calls, conversely, are the right to buy the underlying at the strike price on or before the date of expiration. So you're dealing with something that provides you upside potential leverage if you're long it, but if you're short it, what you have done essentially is you have sold that leverage to someone else. And so when you're short calls, your P&L graph looks pretty negative to the upside. And what that means is that if you're just short calls and you don't have anything else against it, as the underlying continues to go up, if it continues to go up, you are essentially incurring that same liability to sell that underlying at the strike price that you agreed upon, regardless of how high the stock goes. So in the case of stock, stock ABC 123, if you have sold, for instance, call it the 70 call, and at the time the stock was trading 65, and now the stock is trading 90, you are incurring the liability where you need to, if you are assigned, if someone exercises and you are assigned, you would be selling that stock at the strike price. And so what that gives you, if you're selling calls naked, is what we call it, naked call sales, which in this case, again, we consider kind of a speculative trade. You are incurring unlimited risk to the upside, because in the case that I just cited, you'd be selling the stock at 70 and the stock's trading 90. So obviously you have upside risk there. If the stock continues to rally, you are still selling the stock at 70. However, if nothing happens, then you get to keep the premium. Well, you get to keep the premium that you sold the call for no matter what. But if nothing happens and your call is not exercised and you are not assigned on that call, then you would be in that situation where 20% of all options expire worthless. That option would expire worthless, and you just get to keep the premium and nothing would happen. However, your inherent risk for a short call position, that is what we call naked calls, is that you have unlimited upside risk and you have very limited downside potential. The ultimate potential of your trade, if you are short calls, is basically the amount that you sold that call for, minus all of the fees and brokerage fees and exchange fees and all of those things, right? You have to take all of those things out as well. Make sure you do that in your math. But one way that people like to kind of turn that trade into something that's a little bit, I wouldn't call it less risky. Let's just say it has a different risk profile. And that would be the covered call, which is you're already long stock or you're entering into a long stock position and you utilize that same leverage, that same call, but instead of just being short it and having unlimited risk to the upside, the reason why we call it a covered call is because you can sell that call and actually execute the same option trade, but completely change the P&L profile of that strategy by being long the underlying stock. Now, what that does is it gives you a limited amount of upside potential, and it gives you unlimited downside potential. Now, in this case, unlimited downside potential would come with being long the stock in the first place. And so there's no way that with just selling calls against an underlying position, you're going to remove 100% of the risk in both directions. And so really what this is a way for people who are generally people who are long underlying stocks use this to sell calls against it and generate income. Because again, when you sell that option, you are credited that amount of premium in your account immediately. But what that means when you're long the stock and short the call is that you are actually using the call to generate income on a long stock position. And if the stock were to go up to the point where that call would become what we term an exercisable call, or if it were in the money, where people generally tend to exercise options, your stock would be called away from you because you're short that call, and someone would want to exercise the call that they bought and that you sold, and you would incur the liability of which you would need to deliver that stock. Well, in that case, if you're selling upside calls and you get to participate and you're long the stock also, you get to participate in the rally because of your long stock position up to the strike at which your option becomes something that someone might exercise. And then you're giving up the upside beyond that strike price. And so what that looks like is unlimited downside risk because of the stock position that you have, but you're giving up a little bit of the upside potential by selling that call. You really want the stock to kind of rally up to the strike price, because at that point, you would actually be called away and you still get to participate on that rally. And so that's two different ways that people use these calls in order to, A, speculate on the calls being maybe worth less than they are right now later on, and B, they can use them to generate income on already existing long stock positions.
Okay, great. Thank you. That certainly makes sense. Earlier, you were talking about puts, specifically buying puts as a means to mitigate risk. What about selling puts? How does that work out in terms of income generating?
Yeah, that's another great question. So obviously, when I talk about options, I really talk about kind of the world being bisected into two main categories, calls and puts, right? And puts have a little bit of a different, they have a different risk profile. Obviously, they have a slightly different vibe as well because of something called skew, which is an underlying implied volatility level of puts. Generally speaking, in the U.S. equity market, puts are generally a little higher than calls. Not always, but and so a lot of people who look at implied volatility levels like to look at puts specifically on the sell side, because they generally have a slightly higher implied volatility level. Now, when you are selling puts, you have the same risk profile as calls, but in the opposite direction. Keep in mind, puts are the right to sell the underlying at the strike price on or before the date of expiration. So if you are selling that right to someone else, you are incurring the liability if you are assigned on your short put. If the person who is, someone is long that put is going to be exercising that put, they are going to be selling the underlying. And if you are assigned on a short put position, you are going to be buying that underlying at the strike price on or before the date of expiration when you're assigned on it. And so what you are really doing if you're selling what we call naked puts or selling, speculative put positions, is that you are creating an unlimited downside risk if the stock or the underlying were to go down below that strike price and that option were to become, highly likely exercisable option, you would theoretically be assigned on your option position, and you'd have to buy the underlying stock at the strike price. And so if that underlying were to continue to trade lower, obviously you would still be contractually obligated to pay the strike price for it. So you have unlimited downside risk in that situation. Now, what you have, much like in selling naked calls, if you're selling puts, you actually get to keep the premium that you sold it for, and that is what comprises your upside potential. If nothing were to happen and you were selling puts or sold a put and absolutely nothing happened and the option did not get exercised and you didn't get assigned, you would just be keeping that premium. Now, that premium is the actual total possible amount that you can make on that trade. You're not going to make any more than that if your only position is being short that put. Now, there's another way that people use puts, and we term it the cash secured put. Now, this concept is something that people utilize sometimes in a way. If let's say you're looking at a stock and this theoretical stock is trading $25, and you look at the chart and you think that there's a whole host of reasons why the stock shouldn't go down to a price less than $20. So $5 down from where it is now. And you think that's a great place to be long the stock. You look at the chart and you think, man, I wish I could buy this stock for 20. If I could buy this stock for 20, I'd be a really happy camper. Well, in that case, the way that some people utilize these puts, and short puts in this case, would be to go find that 20 put and sell it, thus generating the actual premium that you'd be selling that put for goes straight into your account, and then essentially taking the money that you would need in order to buy the underlying position that option would create if it were assigned, putting that money aside so that you actually have that money in case someone exercises that put and you are assigned on your short put and are forced to buy the stock. So you would need to take all of the money that you would need to actually buy the stock for 20 and put that aside and sell that option and wait, essentially. And what you're doing is you're selling time in order for that position to work out. You're looking at it in terms of if the stock were to go down to 20, for instance, and I got assigned on my put, I kind of wanted to buy the stock there anyway. And so I get to, let's say the put was trading $2. So you would sell that put for $2. You get to keep the $2. If nothing happens and the stock doesn't go down, you get to keep the $2 and it doesn't, the put doesn't get exercised and you don't get assigned. You would get to keep the $2, and theoretically, people do that over and over and over again. If things don't actually pan out to the point where the stock goes down to the point where you would want to buy it. Now, the important part here is that you have the actual capital set aside to be able to execute the stock trade that you are incurring the liability to have to do by selling that put. Because selling puts in this case, especially a cash secured put, means that you actually kind of want to be assigned at that price. And so you need to make sure that's part of your strategy.
Okay, great, Matt. Thanks for that. And that brings to mind the rinse and repeat strategy where an investor sells a covered call and upon assignment, they deliver their stock and then use the proceeds to sell a cash secured put. If that cash secured put then gets assigned, they're now long stock and they sell a covered call against it and rinse and repeat. Obviously, there's a bit more to it, but that's the gist of it. And of course, obviously, it's not without its risks, as you had mentioned. And speaking of which, speaking of risks, I do see that we're running out of time, but I do want to talk about hidden risks, namely when it comes to exercise and assignment. So though it's not entirely common, it is possible that a seller of a credit spread will let their long leg expire unexercised at expiration. Let's say it's out of the money or even at the money for that matter. But then they're suddenly assigned on the short leg, and now they're unexpectedly either long or short stock. So if you can take just a minute or two, tell us why this happens and how.
Yeah, Mark, that's a really great question, and I think it's really timely. It's a situation where you need to really pay attention very closely around expiration specifically, because at expiration, that's when this whole assignment and exercise process becomes very, very P&L centric, right? It's something that a lot of times when I talk about options, I talk about the exercise and assignment process first, because I think it's really important to understand that, and it doesn't get talked about enough. And here's the reason why. The first reason why it doesn't get talked about a lot is because it generally happens towards the end of an options lifetime. People don't like to think about that. They like to think about like how much money they're going to make and all of these different trading things that are going to happen. What you really need to build in is the idea that the options expiration is very, very important. So you need to understand how these options are going to expire before you actually enter into the trade to begin with. Here's a situation where this might happen. Let's say you're trading options on a stock and it's trading $60, and you have a credit spread on. You have the 65-70 call spread on, and you are a credit spreader. So you are short the 65 calls and you're long the 70 calls. And as expiration comes closer and closer and closer, you're looking at it, you're thinking, okay, well, this thing is out of the money, nothing's going to happen. I'll just go ahead and leave it, and I won't close the position. Closing the position in this case would be buying the 65s and selling the 70s out. You'd be buying your call spread back. But you decide, I'm just going to leave it on. It's all going to expire worthless. It's not a big deal. Well, at the bell, the actual closing bell on the Friday of expiration, the stock is trading, let's say, $62, right below your short strike. You're short the 65s. You again look at it and you think, okay, this is fine. Nothing's going to happen. It's all good. Well, after the bell, something happens and the stock goes from 62 up to 67. So you need to look at what's about to happen here. And it's something that is really intrinsic in the expiration process that you need to understand. If that stock goes through the 65 strike, your position changes very dramatically right at expiration. Now, it didn't go through before the stock stopped trading, but something happened in the after hours that made it go up to 67. You are still short the 65 call if someone else can actually exercise that call. Those time frames after expiration can change or are different from brokerage house to brokerage house. Each brokerage or trading firm has a different set of times for which they use in order to control their own operational risks, where they can accept exercise advice or contrary exercise advice from people who are long options. And so what you're dealing with is a situation where you need to very closely monitor that, because if you are assigned on that situation, you would actually be short the stock from 65 with it trading 67. And you also need to pay attention to, especially if you're a credit spreader or you're generally short options, when you could potentially be assigned on options like that if there are potential moves that happen after hours.
That's great, Matt. I really appreciate that. Great information. And as we're out of time, I just wanted to take a second and thank you for joining me today. And thanks for such fantastic information. Before we sign off, I want to invite our listeners to send us your questions to be featured in a future segment of OIC's Wide World of Options. You can contact us via email at options@theocc.com or live chat on our website, optionseducation.org. And while we respond to your questions directly, we might also share your question with our listeners in a future podcast. So thanks again for listening. We'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.